Welcome, my name is Vincent Luz with Forex Trading Institute. Please take a couple minutes and go over the following risk disclosure. Lesson 4, Equity Management. Although you may never quantify how much you can make in a trade, you can quantify how much you're willing to risk to lose, and you must manage your risk. This is a very important lesson. I see a lot of people overlook this lesson, and the difference between you becoming profitable and non-profitable is not going to come whether obviously the strategies help and all the analysis helps, and obviously that's a big part of it, but the equity management, that's what comes down to, because you can do your analysis perfect, but if you don't follow equity management, you're not going to become profitable. Why do traders fail? They're trading to get lucky and make money. They don't have no clear strategy. Their greed exceeds their need. They need to pay their mortgage tonight, and they need to make $1,000 tonight in the market. It's not what you need to make. It's what the market's going to give you. They think that trading is a game of chance and luck, and they do not give the proper education to succeed. They're not willing to pay for their education or mentorship. They want to learn by the market, and it becomes a lot more expensive paying it all to the market. They have poor focus, no defined trading strategy. They're more emotional than intellectual. They trade without protective stop losses, and that's a big error. A lot of people tell me, I don't want to trade with a stop. I think that's a huge error. Unsuccessful people act before they think. It has been said that trading is 10% skill, 10% mental, and 80% emotional. So, I mean, you really know how to manage it. I can see that the hardest thing for me to teach people around the world how to trade is learning how to manage their emotions. Emotions are your enemy. The first thing I want you to do is turn off the moving profit and loss window on the dealing station. That is your moving emotional indicator as you trade. It is your financial death sentence. If you start seeing how much money you're making or losing, there's where the emotion comes in. And you want to eliminate the emotion. You want to make this a game of capturing pips. The more emotional you are, the less money you're going to make. And your emotions will be closely tied to your margin account. Most traders get emotional when trading because they trade before they know what they're doing. And they want to trade and getting lucky. They need to make money. And they don't take the time to educate themselves. They risk more than they should on a given trade, and that's the main one. They also don't quantify how much risk. They don't say, you got to go into every trade seeing how much am I willing to risk, and you got to be accepting it. If you have a 50 pip stop loss and you put one standard account, you're risking $500. You got to say, am I willing to lose $500 tonight if my trade doesn't go my way? Okay, so that's how you have to quantify your risk. They don't have a clear trading plan before they execute their plan, and they can't accept responsibility when trading. They want to blame everybody else. It's my fault for teaching bad. It's the world's fault because they're not learning or they're not trading. They start saying this market's impossible. They want to blame everybody else but themselves for not educating themselves and not taking the time to learn and be mentored on how to trade this market. Managing your risk. Successful traders are always trade with a protective stop loss orders. Although you may never quantify how much you can make in a trade, you can quantify how much you're willing to lose in a trade. Successful traders risk no more than 2 to 5% of their margin account. So going back to the example I told you, if you had a standard lot and you had 50 pips stop loss, that's $500. You got to see, and if you had a $5,000 account, $500 of $5,000, that's 10%. You're over the rule there. Okay, you got to be between 2 to 5%. You're going to see the professional money managers around the world. They use this even a smaller frame of 1.5 and sometimes no more than 2% on a given trade. As a rule, individual traders take a greater percentage of risk than money managers. Obviously, money managers are more conservative because it's not their money. The most important is financial survival. What happens if you go through a streak of losses? You want to be able to survive for the long term trading this market. You don't want to become rich overnight. You're not going to become rich overnight in this market. You got to be consistent. You got to be a little turtle trader, right? Getting small pips every day, becoming profitable. You don't want to overtrade your standard account, your 100K account. You can see the example here. If you have 1,000 and risk 50 pips, that's $500. That's 50% of your account if you only have $1,000 in your account. If you had 2,500 and you're risking 50 pips, which is $500 on a standard account, that's 20%. You're still over. You would have to have about $10,000 to risk 500, 5%. Because there, look, you could lose 19 straight trades. And if you learn my strategy, you're not going to lose 19 straight trades. But you would have to lose 19 straight trades to wipe out your account. And you can see that, obviously, if you only have less money, open up a mini account, and it helps you teach the discipline of money management. For example, you had $1,000 and you risk 50 pips. That's where you want to be. That's 5%. You have to wipe out your account, $1,000 account. You would have to lose 20 consecutive times. With 2,500, you would have to lose 48 consecutive times. So you see how equity management could really help you. You need this. This is not whether you want to or not. You have to follow this rule. I want you under 5%. Okay, making money is fun, super fun. I mean, the most exciting thing is to make money on this computer trading. You're gonna see the rush you get. But the hardest thing is learning how to take a loss in the market. It's the single most hardest and most important lesson that a trader has to learn. You got to be able to accept your loss. You can't get depressed because you lose one time. You got to learn that losing in this market, losing a trade is part of the game. You're going to lose, you're going to win some, but you're going to come out profitable at the end. You got to focus on your purpose is to make money. No one is 100% winner. I can tell you the world's best traders win about 50 to 60% of the time. Okay, so you need to focus on that. You don't have to win 100% of the time to make a lot of money. You can win 50 to 60% of the time and make a lot of money. Look at percentages mean nothing. Look ahead. Look at this. What if I told you you could be a 30% winner, 70% loser, and still make money? Look at here. If you do 10 trades, okay, and this could be the same for your mini. Let's just do the example here, the standard. If I do 10 trades and I win 3 of them, and I'm going for 200 pips, okay, and I let my profits run. First of all, that's very important. You got to let your profits run. And I go 3 trades for 200 pips, I made $6,000. Then I lose 7 trades in a row, and I'm taking 30 pip stop losses, and I lose 300, 300, 300, 300. I lost 7 times, 2,100. I still have a net profit of $3,900. And I wouldn't be worried at all losing 7 times if I have $3,900 in my pocket at the end of the week. Okay? And that's very doable. You only win 30% of the time. The world best trader wins 60. I'm just telling you that all you have to do is win 30 half of the time, and you become profitable. So you can't focus on your losses. Make sure they align with your equity management. You got to let your profits run, and that's very important. I see a lot of time people risk 30 pips to make 30 pips. You need to let that profit run. Successful trading, there's a risk-reward ratio. Minimum risk versus reward should be 1 to 1.5. What does that mean? For every dollar you risk, you should at least make $1.50. So if I'm risking $500, and that's why you quantify your trade, because I put a standard lot and I put a 50 stop loss, that means I'm putting $500. I got to make at least 1.5 times that. I want you to get your calculators out and multiply that by 1.5 times to see how much you're ready to have to make. So if I risk 400, I got to make at least 600. 800, I got to make at least 1,200. When going long, never trade without a protective stop. Never, never, never trade without a stop. You never know when the market goes against you. And never move your stop. I know I see traders, they go, I'm going to give it another 10 pips. I'm going to give it another 10 pips. And the market keeps on going against them. And sooner or later, they're down 60, 70, 80, 100 pips. And they say, I'm going to give it another 10 pips. And then they start praying, please come back. And the market doesn't come back. They could have taken a small stop, take a small loss and go on to the next trade. If you're going long or buying first, all protective stop orders must be a minimum of 10 pips below the major low of support, which is point A. If you're watching a chart, if your equity management does not allow you to enter, then perhaps you can wait for a candlestick formation to appear, which might be a C, and execute the trade according to the rules of the formation. This will allow bears to test the low to see if there's any interest dipping lower. If there's no interest, the market will begin to rally. Remember, 50% of the time, the market tests the candlestick formation. Your exit order should be approximately 10 pips before pass high, and a minimum of 1 to 1.5 risk-reward ratio or Fibonacci extension. If you're going short, never trade without protective stop losses. If you're going short or selling first, all protective stop loss orders must be a minimum of 15 pips above the last major high, point A, or a level of resistance if you're watching the chart. If your equity management does not allow you to enter, then perhaps you can wait for a candlestick formation to appear, which may become a point C, and then execute the trade according to the rules of the formation. This will allow the bulls to test the high and to see if there's any interest in rallying higher. If there's no interest, the market will begin to dip. Your exit order should be approximately 10 pips before the past low, which provides you a 1 to 1.5 risk, or Fibonacci extension, whichever becomes first. Temptation is a powerful emotion that can lead to devastating results. As you trade, you're going to be tempted to do all types of things, because you're going to say, oh, I want to make money here. You'll be tempted to get in early without any reason, a feeling of gut, just because I feel, just because. You'll be tempted to get out early, just because you have fear. The market's going to take back what is given to you, because you think you've made enough money, and you're not following that 1 to 1.5 risk to reward ratio. The reason we address the word temptation while trading is due to two very strong emotions that every human has, greed and fear, that tempt us to take action. And you got to make sure you're trading based on plan, not based on greed or fear. All trades cannot work, and many trades can fail. You got to accept it. It's part of the game, losing. Successful traders deal in percentages and probability. Remember, all professional traders, they're not looking to win all trades. They're just putting probability at their favor, and doing the most probability, obviously, it's going to come out profitable at the end. Okay, they look for high percentage trades that have a high probability of paying off, and they focus in on what the track record of working, and they leave everything else alone. Pass on the trade if you are tempted to get in for whatever reason. If you're being tempted and it's not based on your strategy, pass on the trade. If it requires a stop loss that does not meet your equity management, also pass on the trade. If you have not had the time to make a trading plan without a clear entry and stop and know when to get out, don't trade. If for whatever reason you feel uncomfortable, don't trade. If you're not clear with the rules or you don't understand what you're doing, don't trade. If you feel you're being emotionally or self-forced into making the trade, or someone else is forcing you, also don't trade. And if you can't afford the loss, that's a big one there. If you can't afford to lose $200, $300, whatever you're risking at night, don't trade. Don't trade with money that you're going to pay your mortgage with, and that's going to create the fear in you. You want to trade with extra money. The psychology of trading, successful trading, is that you're going to educate yourself how the market works. And this is going to be a process that you want to educate yourself in order to become successful in this market. Have a well-analyzed and well-thought-out plan to trade. Quantify always a potential loss. And I can't stress that enough. You always have to know how much are you risking in dollars and cents on that trade. Don't risk everything on one trade, and don't overtrade. There's no home run trade that I'm going to put everything down because everything looks perfect. That's not the way you trade. Create a trading plan and trade that plan. Do not deviate from that plan without creating and having another clear trading plan. Maintain your focus. Don't marry a trade. You got to have that philosophy. If this happens, I'm going to get in. If this happens, this is what I'm going to do. If the market gets to this point, I'm going to do X thing. Don't marry a trade. Be willing to adjust and change directions in the market. Let the market tell you what it's going to do. And when in doubt, stay out. And here are some personal characteristics of some top traders. They're usually disciplined, they're confident, they're motivated, they're optimistic, they have strategies, they're patient, they're independent, they're hardworking, they know how to take risk, high achieving, energetic, objective. They're organized, goal-oriented, self-confident, knowledgeable, open-minded, determined, ambitious, committed in management. And they envision their success. And that's what you got to do, is vision your success. You got to see that trade going your way and being profitable. If you don't believe you're going to be successful, you won't be successful. And that applies to anything you do in life. If you don't believe, whether you think you can or you can't, either way you're right. Okay, so it's very important for you to follow those steps. Thoughts of a true trader: there's no lotto trade, there's no trade of the century, there's no final trade or destination, there's no ultimate peak, success is never final and failure is never fatal, there's no capacity, only a journey, there's no campsite, only a journey, and the journey is the reward. You got to enjoy trading. I mean, if you really like trading, you know, I do this as a passion. I love trading, and I'm very profitable at it, but I enjoy it. That's the foremost. If you're just doing it for the money, you're not going to be successful. You got to enjoy it. You got to dedicate yourself to this, and the money comes by itself. Okay, my name is Vincent Luz with Forex Trading Institute, and I'm going to see you in the next lesson. I encourage you to go through this lesson several times. I oversaw it when I started trading, and through the years, I realized that this is one of the most important lessons you can ever learn. Okay, so I'll see you at the next lesson. My name is Vincent Luz with Forex Trading Institute.